According to the Federal Reserve Survey of Consumer Finances, households with $2 to $5 million in net worth are one of the fastest-growing segments of near retirees in the country. And yet, IRS data shows upper-middle retirement income bands often carry some of the highest effective lifetime tax burdens. Not because they're ultra-wealthy, but because they're fully exposed. No estate tax shelter, full income tax exposure, and very little room for inefficient decisions. If you're in that range, you're wealthy enough for mistakes to be expensive, but not wealthy enough to ignore them. That's the trap, and most people don't see it forming. If you've built $2 to $5 million, you likely did everything right. You saved consistently, you maxed your 401k, you avoided unnecessary risk, you delayed gratification, and the reassurance you've probably heard sounds like this: you'll be in a lower tax bracket in retirement. That sounds logical until you look at the structure. According to IRS statistics of income data, the majority of retirement assets for households in this range are concentrated in traditional IRAs and 401ks. That means future withdrawals are taxed as ordinary income. Then required minimum distributions begin at age 73 under current law. If you retire in your early 60s with $2 to $3 million largely in pre-tax accounts and earn returns consistent with Vanguard's long-term balanced portfolio assumptions, roughly mid-single digits, your portfolio may not shrink much before RMD age. Then the forced withdrawals start, and they stack on top of Social Security. Here's the line in the data that changes everything. The income thresholds that determine how much of your Social Security becomes taxable, up to 85%, have not been indexed to inflation since they were introduced, according to the Social Security Administration and Congressional Research Service analysis. So more retirees cross those lines over time, even if their purchasing power hasn't meaningfully increased. That's not a headline, that's a structural drift, and it compounds quietly. This doesn't bankrupt people, it erodes them. A 10% difference in marginal tax rate, for example 32% instead of 22%, applied to $120,000 of annual forced withdrawals over a 20-year retirement, can translate into 6 figures of additional lifetime tax. That's not worst-case modeling, that's arithmetic, and it usually happens slowly enough that no one reacts early. Consider a couple retiring at 63 with $3.2 million. $2.1 million in traditional IRAs, $700,000 in taxable accounts, $400,000 in Roth. They assume, we'll spend from brokerage first, taxes will be lower later. For a decade, income looks reasonable. Then RMDs begin. The IRA has grown. Social Security is online. Their combined income pushes them into a higher marginal bracket. At the same time, Medicare premiums increase under IRMAA, which the Centers for Medicare and Medicaid Services bases on modified adjusted gross income. They didn't overspend, they didn't speculate, they followed rules of thumb, but by the time they see the compression, most of the flexibility window is gone. The years between retirement and RMD age were the planning window. Once distributions are forced, the system becomes reactive, not proactive. Here are the hard truths for this segment. First, taxes become the primary constraint. Morningstar research consistently shows that tax-efficient withdrawal sequencing can materially impact lifetime income sustainability. At $2 to $5 million, a 1% improvement in tax efficiency can rival years of incremental portfolio outperformance. Second, no estate tax does not mean no tax problem. Current federal estate exemptions exceed $13 million per individual. Most families in this range won't owe estate tax, but under the Secure Act, inherited traditional IRAs generally must be distributed within 10 years. Those withdrawals are taxed as income to the beneficiary. If your children are in peak earning years, distributions may be taxed at their highest marginal rate. The tax didn't disappear, it shifted forward. Third, Medicare is an income system. IRMAA brackets create premium surcharges once income crosses specific thresholds. Those cliffs are defined annually by CMS. Small increases in income can create disproportionately higher premiums. That makes income timing, not just total wealth, critical. Fourth, sequence risk matters more here. According to J.P. Morgan Asset Management's Guide to Retirement, poor early retirement returns can permanently impair withdrawal sustainability. Meanwhile, the Bureau of Labor Statistics shows long-term inflation averages above 3%. You need growth to preserve purchasing power, but volatility directly impacts lifestyle at this wealth level. You don't have excess capital to absorb prolonged inefficiency. Picture a simple chart. Line 1, total portfolio balance, relatively stable. Line 2, spendable after-tax income, gradually declining during RMD years because of bracket creep and Medicare adjustments. The account value doesn't collapse, but efficiency erodes, and that erosion is rarely visible in basic projections. Before this locks in, there are a few protective moves to evaluate. First, model tax brackets intentionally during the years between retirement and Social Security. Second, consider partial Roth conversions, not all at once, but strategically filling lower brackets. Fidelity's retirement research suggests controlled bracket management often improves long-term flexibility. Third, coordinate Social Security timing with overall tax exposure. SSA actuarial reductions and delayed retirement credits change income stacking patterns, which affects taxation and Medicare calculations. And finally, measure lifetime effective tax rate, not just this year's marginal rate, because the reassurance, you'll be in a lower bracket later, only works if it's tested against actual distribution math. Federal Reserve data shows the median household approaching retirement has far less saved than this range. If you've accumulated several million, you've done well, but higher balances increase the scale of inefficiency. The system doesn't automatically optimize itself for you, it simply follows its rules, and once RMDs begin, those rules become harder to influence. If this helped you see the mechanics more clearly, hit the like button and subscribe for future video updates. Just remember, retirement problems at this stage aren't caused by recklessness. They're caused by quiet math, and quiet math compounds over time. Just stay informed. You've got this. Thanks for watching.